Hello, my name is Dan Deming, and I'm a trader with Stutland Volatility Group in the VIX pit.
Hello, I'm Jamie Tyrrell, a trader with Group 1 Trading, the designated primary market maker of VIX options. The current level of the VIX is close to 20, and a 20 level on the VIX implies between a 1% move and a 1.5% move in the S&P 500 on a daily basis. So 20 on the VIX right now is running a little bit higher than the sort of volatility we've been seeing over the last couple of months, which is more about 15 or just under a 1% move on the S&P 500. Even as the market has stepped down over the last 6 weeks or so, you've seen the market move down in about moves in accordance with that 1 to 1.5% move that the 20 VIX level would imply, which is why we haven't seen as much appreciation during this sell-off as you would during a much more rapid sell-off.
Following up on what Jamie talked about, I like to make two other points. Number one, the steady stream of negative news that the market had to deal with over the last couple of months was already kind of in the marketplace. It was expected that the economy was going to see somewhat of a soft patch. And number two, the market was still well above the lows that had occurred in March of 1256 in the S&P 500 index. So those two factors also reduced the demand for protection in the S&P 500, which also kept the VIX somewhat in check during this time.
Well, the S&P 500 and VIX traditionally do move inversely. There is a strong negative correlation between the two, but they do not always move inversely. One example of this is in March 2009 and during the financial crisis. The VIX hit its highest during October 2008, when the market was falling quite quickly and people were pricing in the possibility that it could rebound or go lower in a very short period of time. We were seeing 5 to 10% moves out of the S&P 500 quite frequently. In March 2009, the S&P 500 actually hit its low, but the VIX was not appreciating during that month because the market was stabilizing, moving downward 1% to 2% a day, and not exhibiting the same volatility we saw when the VIX hit its highs in October.
Well, the normal expectation for the CBOE Volatility Index is around 18. If you look at the history of the VIX going back to the 90s, the current average price, it runs around 18. So that's a normal trading environment. That implies a little bit more than a 1% move on any given day over the next 30 days. Despite the gyrations in the marketplace over the last 6 months, basically going back to the beginning of the year, you can see the S&P 500, for example, at about the same price level as it entered the year. So over the course of the last 6 months, we've seen the market really kind of in a range-bound environment, and that's another reason why I think that you have not seen a marked increase in the volatility index.
Looking into the future, the VIX futures are trading above the VIX cash. Now, that doesn't necessarily mean that the market is pricing in that the VIX is going to move from 20 to 25 over the next few months. Rather, it's pricing in a large possibility that the VIX could stay at 20, move slightly lower, and a very small possibility that the VIX could appreciate significantly above 25 into some of the levels that we saw during the flash crash and the financial crisis of 2008 and 2009.
This is one of those misconceptions that keeps popping up. The VIX was never developed to predict future price movements in the marketplace. The VIX was developed to measure 30-day expected volatility based on option prices in the S&P 500 index.